Somewhere right now, a guy in a very expensive suit is sitting in a very expensive office, managing a very expensive fund, with a team of analysts, proprietary software, Bloomberg terminals, and decades of combined financial experience. And there is a very good chance that a simple, boring, automatically managed basket of stocks is beating him. Not because the guy is bad at his job, not because the analysts are incompetent, because of something structural, something built into how markets work, that makes it almost impossible for even the smartest, most resourceful professional investors to consistently outperform the market average over long periods of time. This is the index fund argument, and it's one of the most well-supported, consistently validated ideas in all of finance. It's also boring, deeply aggressively boring, which is exactly why most people ignore it. And exactly why the people who don't ignore it tend to end up significantly wealthier than the people who keep looking for something more exciting. Let's get into it. Meet Alex. Alex is 26, just got serious about investing after going down a rabbit hole that started with a video about compound interest and ended 3 hours later with Alex having 17 browser tabs open about options trading, individual stocks, crypto, and something called leveraged ETFs. Alex is overwhelmed. Alex wants to invest intelligently. Alex also doesn't want to spend 40 hours a week analyzing financial statements. Alex has a job. Alex has a life. Alex wants something that works without requiring Alex to become a professional investor. The answer to Alex's situation exists. It's called an index fund. It's been around since 1976. The evidence behind it is overwhelming, and it is genuinely one of the most boring financial instruments ever created. We're going to use Alex for this entire video. By the end, Alex is going to close 15 of those 17 browser tabs. What a stock actually is. Before index funds make sense, let's make sure the foundation is solid. When a company wants to raise money to grow, one option is to sell pieces of ownership to the public. Those pieces are called shares. When you buy a share of a company, you own a small fraction of that business. If the business grows and becomes more valuable, your share becomes more valuable. If the business earns profits and distributes some of them to shareholders, you receive a portion, called a dividend. If the business shrinks, becomes less valuable, or fails, your share is worth less, potentially nothing. A stock market is where these shares are bought and sold. Prices fluctuate constantly based on what buyers and sellers think a company is worth at any given moment. That's it. A stock is ownership. A stock market is where ownership is traded. Simple foundation. Everything else builds on this. What an index is. Now we need one more concept before the main event. A market index is a list of companies selected according to specific criteria, used to represent a segment of the market. The most famous is the S&P 500, a list of 500 large U.S. companies, selected by a committee, weighted roughly by their market value. When people say, the market went up 1% today, they usually mean the S&P 500 went up 1%. Other indices, the Dow Jones Industrial Average, 30 large U.S. companies, the NASDAQ Composite, heavily weighted toward technology companies, the total stock market index, basically every publicly traded U.S. company. An index is not something you can invest in directly. It's a list, a measurement, a benchmark. But, and this is the important part, you can buy a fund that tracks an index. That's an index fund. What an index fund actually is. An index fund is a fund that holds all or a representative sample of the stocks in a particular index in the same proportions as the index itself. An S&P 500 index fund holds all 500 companies in the S&P 500. If Apple makes up 7% of the S&P 500 by market weight, Apple is roughly 7% of the fund. If a small company makes up 0.01% of the index, it's 0.01% of the fund. When you buy shares of an S&P 500 index fund, you own a tiny slice of all 500 companies simultaneously. The fund doesn't make decisions about which stocks to buy or sell based on analysis or opinion. It just tracks the index, automatically, mechanically, no judgment required. This is called passive investing, as opposed to active investing, where a manager is making decisions about what to buy and sell based on research and analysis. The passive nature of index funds is not a weakness. As we're about to see, it's their primary competitive advantage. The active management problem. Here's the core argument. Pay attention. Active fund managers, the professionals with the expensive suits and the Bloomberg terminals, are trying to beat the market, to pick stocks that outperform the average, to time the market in ways that generate better returns than just owning everything. Some of them succeed in any given year, some of them have multi-year runs of outperformance. But here's what the data shows consistently, across decades, across multiple studies and research institutions. The majority of actively managed funds underperform their benchmark index over long time periods. The S&P indices versus active, known as the SPIVA report published by S&P Global, tracks this regularly. Their findings consistently show that over 15 to 20-year periods, the vast majority of actively managed U.S. equity funds underperform the S&P 500. Not all of them, not every year, but most of them, most of the time, over the long run. Why? 3 reasons, and they're structural, not personal. Reason 1, fees. Active management costs money. Analysts need salaries. Research costs money. Trading costs money. Office space in Manhattan costs a lot of money. These costs get passed to fund investors in the form of an expense ratio, an annual fee expressed as a percentage of your investment. A typical actively managed mutual fund might charge 0.5% to 1.5% annually. Some charge more. An S&P 500 index fund from a major provider charges as little as 0.03% annually. That's 3 cents per $100 invested per year. The difference sounds small. Over decades, it's enormous. A 1% annual fee on a $100,000 portfolio costs $1,000 in year 1. But it also costs you the compounding that $1,000 would have generated. Over 30 years, a 1% fee difference on a growing portfolio can cost tens of thousands of dollars in lost compounding. The active manager needs to outperform the index by at least the fee amount just to break even for the investor. Before delivering any actual value, they're already running behind. Reason 2, the market is hard to beat. Here's the part that sounds counterintuitive until you think about it. The stock market is not filled with uninformed participants making random decisions. It's filled with professionals, fund managers, analysts, algorithms, institutional investors, all with access to the same publicly available information, all trying to find undervalued stocks before the next person does. When everyone competing is sophisticated, information gets priced in almost instantly. The moment a piece of news becomes public, thousands of professionals act on it simultaneously, adjusting prices until the opportunity disappears. This is called market efficiency, the idea that current prices already reflect all publicly available information. If the market is even roughly efficient, then finding consistently mispriced stocks, ones trading below their true value, becomes extremely difficult. Because everyone else is looking for the same thing with the same information. Active managers aren't competing against confused amateurs. They're competing against each other. In aggregate, they are the market. Half of them will beat the average. Half will underperform. Before fees, active management is a zero-sum game. After fees, it's a negative-sum game. The index fund sidesteps this entirely. It doesn't try to beat the market. It is the market. It accepts the average return. And because it has almost no fees, it delivers something very close to the full market return to investors. Accepting the average when the average beats most professionals is not settling. It's the smart play. Reason 3, the consistency problem. Even active managers who outperform in one period rarely maintain that outperformance consistently. Research on fund performance persistence shows that funds which outperform in one 5-year period are not reliably more likely to outperform in the next 5-year period. Past performance, in other words, is a poor predictor of future performance, which is why every investment disclosure legally requires the phrase, "Past performance does not guarantee future results." This creates a practical problem for anyone trying to pick an active fund. Even if you could identify the managers who will outperform, which the data suggests you can't reliably do in advance, you'd need to keep identifying them as their edge disappears and new ones emerge. Meanwhile, the index fund just keeps tracking the index. No selection required, no ongoing evaluation, no risk of picking the wrong manager. Alex, looking at those 17 browser tabs full of top-performing funds, needs to understand that most of those rankings are looking backward. The future is a different question. One the data suggests the index fund answers more reliably than most alternatives. The diversification benefit. There's another advantage to index funds that doesn't get enough attention. An S&P 500 index fund holds 500 companies across dozens of industries: technology, healthcare, financials, consumer goods, energy, utilities, and more. When one sector struggles, say energy companies during an oil price drop, other sectors may hold up or even benefit. The diversification smooths out the ride. With an individual stock, if the company has a bad quarter, a scandal, a competitor breakthrough, or a product failure, your investment takes the full hit. Alex picking individual stocks is concentrated. Alex's money is tied to specific bets on specific companies. One of those companies imploding hurts Alex directly. Alex in an S&P 500 index fund owns 0.01% of that same company. If it implodes, Alex barely notices. The other 499 companies absorb it. Diversification doesn't maximize returns. It manages risk, which over long time horizons is actually more important for wealth building than chasing maximum upside. The index fund is, by design, the most diversified you can possibly be within a given market. The expense ratio, the most important number. When Alex looks at an index fund, there's one number that matters more than almost anything else: the expense ratio. This is the annual fee the fund charges, expressed as a percentage of your investment. It's deducted automatically from the fund's returns. You don't write a check, it just quietly reduces your balance. Well-established S&P 500 index funds from major providers, Vanguard, Fidelity, Schwab, offer expense ratios as low as 0.03% to 0.04% annually. Some actively managed funds charge 1% or more. The math on this difference, compounded over decades, is significant. At 8% average returns on a $10,000 investment over 30 years. With a 0.03% expense ratio, approximately $99,500. With a 1% expense ratio, approximately $76,100. Same investment, same return, different fees. A $23,000 difference. From a fee that sounds like almost nothing. When Alex is choosing between index funds, lower expense ratio wins, almost always. Types of index funds. Not all index funds are the same. Here's a quick orientation. S&P 500 index funds. Track the 500 largest U.S. companies. The most common starting point. Examples include VOO from Vanguard, IVV from iShares, FXAIX from Fidelity. Total market index funds track the entire U.S. stock market, large, mid, and small companies, slightly more diversified than S&P 500. Examples include VTI from Vanguard, FSKAX from Fidelity. International index funds track companies outside the U.S., adds geographic diversification. Examples include VXUS from Vanguard. Bond index funds track bonds instead of stocks, lower historical returns than stocks, lower volatility. Useful for balancing risk as you approach retirement. Target date funds, a mix of stock and bond index funds in one product, automatically rebalancing over time toward more conservative allocation as your target retirement year approaches. We covered these in the 401k video. For Alex, starting out in their mid-20s with a long time horizon, an S&P 500 or total market index fund is the most common, defensible, straightforward starting point in the investing world. ETFs versus mutual funds. One more distinction Alex needs. Index funds come in two structures: mutual funds and ETFs, exchange-traded funds. Both can track the same index. The differences are mostly mechanical. Mutual funds price once per day after the market closes. You buy and sell at that daily price. Minimum investment requirements vary. Some have no minimums. Some require a few $1,000s to start. ETFs trade throughout the day like stocks. You buy one share at a time at the current market price. No minimums beyond the price of one share, which for many funds is under $100 or even under $50. For most long-term investors, the difference is minor. Both can be low cost. Both can track the same index effectively. In a 401k, you're usually choosing from mutual funds. In a Roth IRA or regular brokerage account, ETFs are often easier to access with no minimums. Alex, opening a Roth IRA with $500 probably starts with an ETF. Lower barrier to entry, same exposure. The one risk nobody mentions. Index funds are not risk-free. Full stop. When the market drops, and the market drops regularly, sometimes severely, your index fund drops with it. An S&P 500 index fund fell roughly 50% during the 2008 financial crisis. It dropped sharply in early 2020. It had a significant down year in 2022. The index fund doesn't protect you from market downturns. It gives you exactly the market return, which includes the bad years alongside the good ones. The reason this is manageable, the reason the long-run data still looks compelling, is time. Every historical market downturn has eventually been followed by recovery and new highs. Investors who stayed invested through the drops recovered. Investors who panicked, sold at the bottom, and locked in losses did not recover. The risk of index fund investing is not that the fund is poorly designed. The risk is that you sell when it goes down. An index fund in the hands of a patient investor who doesn't panic sell is a fundamentally different instrument than the same fund in the hands of someone who checks their balance during every market dip and makes emotional decisions. The fund is the easy part. Not panicking is the hard part. Alex needs to understand this before buying a single share. Because the first time the balance drops 20%, and it will at some point, the right move is to keep buying, not to sell. Alex's decision. Let's bring it home. Alex has been staring at 17 browser tabs, options trading tutorials, stock picks, crypto analysis, leveraged ETFs, each one promising an edge, a shortcut, a way to get rich faster. Here's the honest comparison. Options trading, high complexity, high risk, requires significant time and knowledge. Most retail traders lose money. Individual stock picking requires constant research, high concentration risk. Most individual investors underperform the index over time. Crypto, high volatility, speculative, not appropriate as a core investment position for most people building long-term wealth. Leveraged ETFs amplify both gains and losses, designed for short-term trading, not appropriate for long-term holding. S&P 500 index fund in a Roth IRA, boring, diversified, low cost, historically outperforms most alternatives over long time horizons, requires approximately zero ongoing management. Alex wants something that works without requiring Alex to become a professional investor. One of these options fits that description. Alex closes 15 tabs. Rapid recap. Everything. A stock is ownership in a company. A market index is a list of companies used to measure market performance. An index fund holds all the stocks in an index, tracking it automatically without active management decisions. Passive index funds consistently outperform the majority of actively managed funds over long time periods. 3 reasons. Fees drag on active fund returns. Markets are hard to beat because professionals are competing against each other, and outperformance doesn't persist reliably. Index funds offer built-in diversification across hundreds of companies. The expense ratio is the most important number when comparing funds. Lower is almost always better. Major index fund types: S&P 500, total market, international, bond, target date. ETFs and mutual funds can both track the same index. ETFs are easier to access with no minimums. Index funds drop when markets drop. The risk is not the fund. It's selling when it goes down. Patient, long-term index fund investors have historically been rewarded. Panic sellers have not. Alex closes 15 tabs, opens 1 account, buys 1 fund, leaves it alone. Boring wins, consistently, over time. Final takeaway. The most powerful investing strategy available to most people is also the least exciting one. No edge, no special knowledge, no timing, no stock picks. Just own everything. Keep costs low. Don't panic. Wait. The finance industry profits from complexity. Advisors, active funds, trading platforms. They all need you to believe that something more sophisticated is required, that you need their expertise, their analysis, their product. You mostly don't. A low-cost index fund in a tax-advantaged account, started early and held consistently, beats most of what the industry is selling. It's boring. It's proven. It's available to anyone with $50 and a brokerage account. The boring bet usually wins. Place it. If this video made you want to actually open an account and buy your first index fund tonight, that's the goal. The research phase ends somewhere. This might be that somewhere. Hit subscribe. Next video, we're talking about how student loans actually work and how this one decision quietly shapes your financial life for years. Drop a comment. Are you currently invested in anything, or are you still in the research phase? No judgment. Genuinely want to know where people are starting from. See you there.